to pullbacks, if not a correction. Is this what we're starting to see now, do you think?
It's probably a bit too early to say that after just one day itself. So what we have to look back is also that we have seen 9 weeks of rallying, especially in the US market itself. So overall, what we have to say is also we are at a better place compared to 1 year ago. So if you look at it, we have at least completed the interest rate hike cycle. Inflation is coming down, but nevertheless, as the key issue is really that US markets are at elevated levels from a valuation point of view. That's why we are a bit more cautious on the US market.
How critical is that 4% level on the US 10 years? Always a competition in terms of allocation, right?
The 4% level on the treasuries, it's more a psychological level. I think what's important there is we don't expect the rate to come down at the moment further. That's also where we have to be prepared that rates still go slightly higher up, especially also above the 4% handle. And that's where we see that investors might get nervous when they see a higher level there, where they might also rethink about, do we really see the rate cuts coming in March? Where we are not part of that league. We expect the rate cuts to come in later during the mid of the year, where we see some negative surprises coming in on the investor side when they see that might not happen.
Okay. Thomas, you say markets have pushed recession risks too far into the background. So at what point then does bad news really start to become bad news in the market psychology? And does this suggest that we should position cautiously as opposed to jumping on board this rally?
That's right. So we say it's time to position for both outcomes. At the end, it's really a bit it's tricky between the soft landing and the recession itself. That's also where we currently position more towards a market where we can play both sides. That's also where we see currently, as an example, fixed income more interesting compared to equities, but there are good opportunities out there still on the equity side as well. So that not to lose outside of that.
Opportunities in fixed income as well?
Yeah, fixed income. So what we see in fixed income, we have added some risk in short-term high-yield bonds global. That probably sounds a bit contradicting, but what we are seeing there is that we want to make use of the inverted interest rate curve, which we still have at the short end, which gives you a really nice premium where you can get global US high-yield bonds at roughly at an interest rate of 7 to 8% with a duration of roughly 2.6, 2.7 years, where it's kind of a nice hedge for both parts to play out, if we see a soft landing or even a recession.
How much of that optimism in terms of global high yield is because with the fresh rate cut cycle around the corner from the Fed, that potentially, and I stress here, potentially could decrease the risk of defaults?
That's exactly what we see. So we expect also there that even if spreads rise, the compensation you get with the yield on this short-term high yield will reward you for that, which is why we see it's something which plays out in both ways, in a recession scenario as well as in a soft landing scenario, where we even might see double-digit returns.
Wow.